Hello, my awesome accounting students. I'm glad you're back today to study Chapter 6. Chapter 6 represents the last few steps in the accounting cycle. Chapter 6 is all about the closing process and the end of period transactions that all companies need to go through in order to close out one period so that they can start out fresh with the new period. Before we head on and talk too much more about Chapter 6, let's walk ourselves through the accounting cycle. The accounting cycle is a series of steps that all businesses need to perform in order to get the information out of the accounting system to the users of the accounting information. We've gone through the steps in the accounting cycle before, but this is a good time to review them. First, we learned that we analyze the transaction. Secondly, we journalize the transaction. We learned that the journal was a great way to keep a record of the financial transactions as they happen, but the journal had a problem. It didn't track the balances. And so then we learned to post to the general ledger. The ledger is the accounting document that keeps track of the cumulative balances. After that, we learned how to complete a trial balance. This trial balance was the starting point for our next step in the accounting cycle, which is the worksheet. We learned that the worksheet was an internal tool used to gather the information needed for the adjusting process. After we completed the worksheet, we completed a set of financial statements for a company. The financial statements that we learned were the income statement, the statement of owner's equity, and the balance sheet. Once the financial statements were created, we then learned that we had to journalize and post the adjusting entries to get them into the accounting records. That brings us current and ready to talk about the last few steps in the accounting cycle. Let's learn more about the closing process. There's two basic reasons why we need to go through the closing process. The first reason is that some accounts are called nominal accounts or temporary accounts. This means that they start off the period with a zero balance, they accumulate over the course of the accounting period, and then they need to be reduced back down to zero. Nominal accounts are comprised of revenues, expenses, a new account called income summary that we'll talk more about later, and the drawing account. So the first reason that we need closing entries is to close out the nominal accounts. The second reason that we perform the closing process is because, as you saw in the last chapter, the statement of owner's equity had a capital balance on it that didn't match the capital balance in the general ledger or on the worksheet. This creates a problem. So the second reason we do closing entries is to update the owner's capital account for two items. We'll update the owner's capital account for net income or possibly a loss, and we'll update it for the drawing, which is the amount that the owner takes out for his or her personal use. No matter what size the company is, or no matter what industry the company's in, there are 4 entries which need to take place in order to accomplish the goals of the closing entries. They are done in a specific order. First, we'll locate all the revenue accounts and close them out. Second, we'll locate all the expense account and close them out. Revenues and expenses will be placed in what I call the junk drawer in a brand new account called Income Summary. Income Summary will be a temporary holding account that will place the revenues and expenses in. I almost look at it as if it's a junk drawer. I know you all have one around your house that you just kind of toss things into and then know that you'll clean it out later. Income Summary will be the junk drawer we use to temporarily hold the revenues and expenses. The third journal entry will be to close the Income Summary account out, kind of like picking up that junk drawer. If you think about it, what's inside the Income Summary account are the revenues and the expenses. So when we foot the Income Summary, we will find out the amount of net income or net loss. We will close that out to the owner's capital account. And finally, the drawing account will also need to be closed out. We'll close the drawing account also out to the capital account. Drawings make the owner's capital account go down. So once again, the purpose of this slide is to reinforce that 4 journal entries are needed in the closing process. Close the revenues, close the expenses, close the Income Summary, and close the drawing. Let's check out how to do that. Closing is a game of opposites. The goal of closing is to wipe out or erase the nominal account balances. That means that whatever balance the account has needs to be wiped out to 0. The concept of normal balances that we studied in a previous chapter become important in the closing process. The first step in the closing process is to locate and wipe out the revenue accounts. In this chapter, there was only one revenue account called Fees Income. Since the current balance is $47,000, we need to zero that out by doing the opposite. That means we want to debit the fees income for $47,000 and temporarily transfer it to that junk drawer account called Income Summary. Notice that after the closing, the fees income now has a 0 balance, and the Income Summary is temporarily holding the revenue amount of $47,000. So on to the expenses. On the screen are the 5 expenses that Eli's consulting service had. Salaries, utilities, supplies, rent, and depreciation expense are all expenses that have normal debit balances. The goal is to close out or wipe out each individual expense so that you can start the new period afresh with a 0 balance. How do we do it? Closing is a game of opposites. So because we have to list debits first, I'll put a placeholder in here for an Income Summary debit, and I'll go through and individually credit each individual expense account. As always, the sum of the debits must equal the sum of the credits, so you get the Income Summary amount by summing up the 5 expense categories. Take a look at the journal entry. One single debit to Income Summary for the total of all the expenses added together, with individual credits for each expense account to wipe each one of them out to 0. So we've wiped out the revenues, we've wiped out the expenses, they've all been closed out and have a 0 balance, and they're hanging out in the junk drawer called Income Summary. Now we need to foot the Income Summary account and wipe it out to the capital account. Net income will make the capital account go up. Net losses will make the capital account go down. So look at the footed total of income summary and do the opposite to transfer it to the capital account. In this case, to close out the income summary, we will debit it for $33,667, the amount of the net income, and we will credit the owner's capital account. The owner had an existing capital balance in the account already. So with that last journal entry, that net income pulled his capital account up. The way we increased his capital account was with a credit. Take a moment to review this screen again. There's a lot going on, and this journal entry probably gives students the most trouble of all. On to the last step, which is to close out the drawing. Drawing was a contra equity account that had a debit balance. The goal of closing entries is to wipe it out. So to close the drawing account, we would credit the drawing account and debit the capital. Some students make the mistake of closing this out to income summary, but remember the income summary is already closed out. So to close out the drawing account, credit the drawing and debit the capital. By debiting the capital, you bring the owner's net worth down. Here's a final snapshot of the owner's capital account. You'll notice that the capital account now matches the statement of owner's equity. That's because the closing process has successfully been completed. He started off with a $100,000 beginning balance. We added $33,667 in net income to his capital balance, and we subtracted out the $5,000 because of his drawing. In other words, his capital account is now properly stated. Because the debits and credits have been flying everywhere during the closing process, the last step is to prepare a post-closing trial balance. Post-closing literally means after closing, just like post-war era means things that have happened since the last World War. You'll notice that the only accounts left in Eli's consulting services are the real or permanent accounts, which are the assets, the liabilities, and the owner's equity. As always, make sure the debits equal the credits. Ta-da! We've done it! We've learned the complete accounting cycle for a service-oriented firm. Take a moment to review this slide and see if you can list the accounting cycle steps in order. I'm proud of each and every one of you. You've stuck through it and we've learned a complete accounting cycle. So what will we do on the last half of the semester? We're going to change our focus to merchandising operations. This is Professor Johnson signing out.